Welcome to Iron Financial. In a market that's full of noise and, let's be honest, a lot of uncertainty, our job here is to forge a path to a stronger portfolio. We do that by finding companies built not on hype, but on foundations of solid steel. Today, we are putting IDEXX Laboratories, ticker IDXX, through a really rigorous financial stress test. We're going to examine the load-bearing pillars of this entire business, we're going to hunt for cracks, and we're going to decide if this structure is sound enough to build into your financial future. You know, when the economic winds really start howling, investors, and I mean smart investors, they look for shelter. They're looking for companies with those deep moats, those resilient business models. And for years, the pet care industry has been seen as exactly that, one of those safe harbors. It's an industry powered by something that feels non-negotiable, the love people have for their pets. IDEXX, as a global leader in veterinary diagnostics and software, well, it sits right at the very heart of this idea. So on paper, it's a prime candidate for a portfolio that's built to last. But the big question we have to ask ourselves today is that reputation, that bulletproof status, still truly warranted? Whoa, hold on a second. Let's just pump the brakes right there. Recession-proof is a term that gets thrown around way too easily. You know, it's almost become a cliche. The pandemic puppy boom, sure, it was a massive tailwind. I mean, no doubt about it. But what happens when that tailwind just fades? What happens when it turns into a headwind? What happens when inflation is squeezing every household budget and people have to make some really tough choices? We're already hearing whispers, and more than whispers, about pressure on vet visits. The bottom line is that no company, I don't care how beloved its industry is immune to economic gravity. So before we go ahead and declare this thing a fortress, I want to see how it actually holds up under some real sustained pressure. Are we absolutely sure this boom isn't starting to show some pretty serious cracks? And that is a fair challenge. It's a completely fair challenge, and it's exactly why we always start our stress test right at the foundation. For any truly great business, and this is especially true in the diagnostic space, the absolute core pillar is recurring revenue. Look, this isn't about flashy one-time sales. It's about that predictable, that reliable, that repeatable stream of income that comes from a loyal, completely embedded customer base. It is the engine that powers everything else in the company. So let's put that engine on the dynamometer, let's crank it up, and see what kind of power it's really putting out. Okay, well, this slide right here gives you the answer in plain, hard numbers. And this is critical. We're not just seeing growth here. We are seeing acceleration. Let me repeat that, acceleration. We're looking at the organic growth in their companion animal group, we'll call it CAG, which is the absolute heart and soul of IDEXX's business. In the fourth quarter of 2024, they posted a really solid 7% organic growth. I mean, most companies would kill for that. But just look at Q4 of 2025. That number didn't just hold steady, it jumped to 10%. This is not a story of stagnation or decline. In what everyone agrees is a challenging environment, this is a clear, undeniable sign that the engine isn't just running, it's actually picking up speed. This is our first piece of hard evidence that suggests the core of this business is incredibly strong. So the next question is why? Why is it accelerating? This isn't just happening by magic. It's because of a beautifully designed business model. Let's break this down. First, look at premium instrument placements. They're up a staggering 42% in the quarter. This is the classic razor and blade model. IDEXX gets its diagnostic machines, the razors, into more and more vet clinics. Second, that directly grows their global installed base, which expanded by 12%. This is their footprint, their territory, and it's getting bigger. This creates the absolute perfect setup because once that razor's in place, what do? You sell the blades. And those blades are the IDEXX Vet Lab consumables. Those are the high-margin, repeatable sales that just keep coming in month after month, and they grew 15% organically. This model is firing on all cylinders, with robust 9% growth in the mature U.S. market and an even more impressive 12% internationally, which tells you they have a very long runway for global expansion. Okay, that's a powerful story. I get it. The razor and blade model is a classic for a reason. It works. But a real stress test isn't just about standing back and admiring the strong parts of the building. It's about taking a hammer and looking for the potential weak spots. Every single structure, I don't care how well it's designed, has points of stress. The numbers you just showed, they are impressive. But let's be real. They're from the company's own highlight reel. Now it's time to apply some real pressure and start inspecting for cracks. Let's see what management themselves might be warning us about. And there it is, right on cue. This isn't me speculating. This isn't some bearish analyst on Wall Street trying to talk down the stock. This is a direct quote from the Chief Financial Officer of IDEXX, Andrew Emerson, on their latest earnings call. Pressure on clinical visits remains a headwind to this sector. I mean, he's putting it right there on the table for everyone to see. If fewer pets are physically going to the vet, that has to, logically, mean less demand for their products down the line. This is the first, most visible crack in the foundation, and what's so important is that it comes straight from the source. You absolutely cannot ignore a warning flare that's been fired by the CFO. Market Skeptic. And let's put some hard numbers on that quote because it matters. U.S. same-store clinical visits fell about 2% in 2025. That's a fact. Now, look at the guidance. The company is building another 2% decline into their own forecast for 2026. So this isn't just a blip. They are telling you it's a trend. They don't see this problem just magically going away anytime soon. So I have to ask the question again. How can a company possibly thrive when the very activity that drives its business, people taking their pets to the vet, is actually shrinking?
Because they're not just passively floating on the industry tide, they are actively and successfully swimming against it. Look at the right side of this slide. This is the countermeasure, and frankly, it's the entire bull thesis in a single data point. IDEXX achieved a revenue growth premium of 1,100 basis points. That's 11 full percentage points over the clinical visit trend. How? They did it by driving higher diagnostic frequency and utilization. In plain English, they are successfully convincing veterinarians to run more tests and more valuable tests on each and every pet that does walk through the door. They are extracting more value from fewer visits. That's an incredibly powerful testament to the strength of their innovation and their sales execution. It means their growth is not dependent on the market. They are actively taking share of the diagnostic wallet.
Okay, I see the counter-argument, and it's a strong one, but that doesn't mean the headwind isn't causing any damage in other areas. We have to look at the whole picture, right? Not just the shiny parts. Buried in their own report is this little data point. Rapid assay revenue, their quick in-clinic tests, it actually declined 3% organically in the fourth quarter. And the reason they give for it? It was directly impacted by lower wellness visits. So while they might be offsetting the decline in one area with higher utilization of their premium lab equipment, there are other product lines that are taking a direct hit. This proves, without a doubt, that the visit decline is a real, tangible drag on parts of the business. It's a crack, and we can't just paper over it with a big picture growth number. You're absolutely right. We can't ignore it. The headwinds are real, but the true measure of a great company isn't whether it faces headwinds, it's how it navigates them. A weak company gets blown off course. A strong company uses its own power to push right through. That power for IDEXX is innovation. It's how they convince vets to run more tests. It's how they create entirely new reasons for a pet to get tested in the first place. So let's look at the blueprint for that future growth. Are they just defending their old territory, or are they actively building new pillars that will support this structure for years and years to come? And this is a perfect example of what I'm talking about. InViewDX. This is their next-generation diagnostics platform. Just think about this. Historically, cytology, which is just analyzing cells to look for abnormalities, it was a manual, incredibly time-consuming process. A vet tech would have to take a sample, stain it, put it on a slide, and then a busy veterinarian would have to spend precious time squinting into a microscope. The alternative was sending it out to a lab and waiting days for results. InViewDX automates the entire thing. It's a slide-free analyzer that gives results in minutes, right there in the clinic. This is a massive workflow improvement, a productivity multiplier for a busy vet practice. And the adoption has been incredible. They placed nearly 6,400 of these instruments in 2025 alone. This isn't just a minor upgrade. It's a total game changer for point-of-care diagnostics. And believe me, it does not stop there. Let's talk about CancerDx. This is a proprietary blood test that can screen for some of the most common canine cancers. Now, just think about the power of that for a second. It completely moves the conversation from just treating sick animals to proactive, early detection during routine wellness visits. It addresses a huge area of anxiety for pet owners, and it provides a brand new, high-value service for veterinarians to offer. This isn't just about improving an existing process. It's about creating an entirely new market for early cancer screening in pets. They've already seen strong traction in North America, and now they're rolling it out internationally in 2026. This is exactly how you create new revenue streams and embed yourself even deeper into the standard of care. The technology is impressive. I will absolutely grant you that. It's cool stuff. But from an investment perspective, we have to look at the financial impact. And again, let's go straight to the company's own guidance, their own words. After a massive launch year for InViewDX, they are forecasting that instrument revenue will decline in 2026. So that big 42% placement growth number we saw earlier, that's not repeatable. It looks a lot like a one-time surge from a big product launch. So the question is the heavy lifting already done? Did they just pull forward a huge amount of demand, and are we now facing a big air pocket in what has been a key growth driver? That's a serious question for the bull case. It's a critical question. It absolutely is. And in the face of that exact kind of uncertainty, a potential slowdown in a key segment, you have to stress test the financial core of the company. Can it withstand a shock? Can it handle a period of slower growth? This is where we stop looking at the growth engine for a minute and we start inspecting the balance sheet itself. Is this foundation built on sand or is it forged from steel? Because a company with a fortress balance sheet has the power to weather any storm and the flexibility to keep investing for the future, even when certain revenue streams fluctuate. And this number, well, this number says it all. Their net debt to adjusted EBITDA ratio is just 0.4 times. Now, to put that in perspective for you, many healthy, stable companies run at 2, 3, or even 4 times leverage. And in today's economic environment, with higher interest rates, that debt becomes a massive anchor. A ratio under 1 is considered extremely low and very healthy. A ratio of 0.4x is practically bulletproof. This tells us the company is not burdened by debt at all. It has immense financial flexibility to invest, to acquire, or to return capital to its shareholders, regardless of what the market decides to throw at it. It is the very definition of a rock-solid financial structure. And this right here is the source of that strength. This business generated $1.1 billion in free cash flow in 2025. But what's even more impressive is that this represents a 100% conversion of their net income. For anyone watching, that means every single dollar of accounting profit on the income statement turned into a real dollar of actual cash in the bank. This isn't just paper profit, it's hard cash flowing into the company's coffers. And cash is the oxygen for a business. It's the lifeblood that allows them to fund the R&D for the next IDEXX, to expand commercially and to reward shareholders, all without needing to take on risky debt. And here is exactly what they do with all that cash. They allocated a massive $1.2 billion to buy back their own stock in 2025. Now think about that. That's actually more than their entire free cash flow for the year, which shows a willingness to dip into their cash reserves to make this happen. This is management making an incredibly powerful statement. They are looking at all the places they could possibly invest their capital, and they are concluding that the best possible return on that capital is in their own shares. It's a direct countersignal to the skeptics' concern about air pockets. This is not the behavior of a management team that's worried about the future. It's a sign of profound confidence in the long-term durability of their business. All right, we've been through it. We've examined the engine, we've inspected the cracks, and we've stress-tested the foundation. We've seen the powerful recurring revenue, but we've also seen the real headwinds from declining vet visits. We've seen the exciting innovation, but we also see the company's own forecast for slowing instrument sales. And yes, we've seen the fortress balance sheet, so let's put it all together. It's time to weigh all the evidence and deliver the iron financial verdict. What are we looking at here? An opportunity forged in steel or a cleverly disguised trap? Let's just summarize it quickly. The bull case is clear and it is very compelling. You have accelerating recurring revenue, which is the absolute gold standard for any high-quality business. You have a massive and still growing installed base of instruments that creates a deep competitive moat that's nearly impossible for a competitor to cross. You have a pipeline of true game-changing innovation like InView-DX and CancerDX, and underpinning all of it is a balance sheet that is, and I'm not exaggerating, a fortress.
But the bear case can't just be dismissed out of hand. The headwind of declining vet visits is real. Management themselves acknowledges it. The guidance for a drop in instrument revenue in 2026, that creates near-term uncertainty, and it's definitely going to put pressure on the stock. And we've seen specific product lines like the rapid assays already showing the negative impact of these pressures. These are not trivial concerns that you can just wave away.
So, the verdict of this financial stress test is in. The headwinds are significant, but the structure is stronger. The foundation is solid steel. IDEXX has demonstrated a truly remarkable ability to counteract sector-wide weakness through superior execution and relentless innovation. They have proven that they can grow revenue even when their end market is shrinking. The combination of their recurring revenue engine, their powerful innovation pipeline, and their absolute fortress of a balance sheet creates a structure that can not only withstand the current pressures, but is actively being reinforced to build even higher in the future. The foundation does seem solid, but as we saw, some cracks are visible. And the question for every single investor out there is about their own tolerance for risk and, of course, their timeline. IDEXX has certainly proven its resilience, but the path forward won't be without its challenges, and the market may not reward that resilience in the short term.
And that really is the final question we're going to leave with you. We've conducted the stress test. We've laid out the evidence on both sides. Now, you have to be the architect of your own portfolio. Looking at this blueprint, would you build with this company? The decision, as always, is yours. Thank you for joining us on Iron Financial.